Hi everyone. Good afternoon. So very interesting sessions here today, but I think my session will be a bit more simple, I guess. So before I start, I would just like to gauge the audience, and I have a hypothesis that I want to share with you guys, and it is that retail participation in bonds in Malaysia is growing. So I would like you guys to participate with me a bit here to show me a hands for those who have actually invested in ringgit bonds, or either through funds or individual bonds. So any show of hands, please. Okay, yeah. So I guess my hypothesis there is true. And actually the ringgit bond space has been growing a lot, and it has been currently one of the biggest bond space in Asia. And similarly to the sort of small research that I did just now, I also did talk to my friends and family about bonds. So my hypothesis then was the awareness on bond is not there yet. And so I talked to them a bit, and sadly to say, they exceeded my expectations. The awareness wasn't there. And I think generally we see that in the retail market as well. And when you see a lot of misconceptions out there, I sort of just want to address them today. So we'll start with the first one. And I think generally I've seen a lot of people here saying this as well. And when I talk to my friends and family, I'll ask them, I'll share with them my ideas of bonds as an analyst. And they'll tell me things like, hey, what you tell me are very expensive, I need to invest 250,000. But yeah, that's where the misconception comes in. And I think a lot of it stems from how the bond market was previously. And when retail participation starts to come in, we see more and more businesses come in and try to attract retail participation. And our platform is one that is trying to do that. And as you can see, and if you look through our platform, you can see our Bond Express, which is a platform that we try to get people to participate in retail. So you can see from Bond Express, we have a minimum investment of 5,000 only. So maybe we can just clear this misconception. You don't need 250,000. Bonds you can diversify through our Bond Express, where we try to give you lower investment amount. And following that, the second misconception is all bonds are the same. And I see where this misconception comes from. Because I think generally when retail starts coming in, they will start thinking bonds are just debt, right? And when they think that bonds are all debt, they think all debts are the same. So that's where I think it stems from. So yes, they are debt, but they are not all the same. I think if you know, even with banks, your personal loan, your mortgages can be structured very differently, right? So in general, bonds, just to give you an idea, bonds are just debt securities, but they can be structured very differently. So in terms of bonds, we can classify them as sovereign bonds, investment grade bonds. Those are bonds that are issued by investment grade rated issuers, which are rated BBB and above. And then high yield, and lastly distress. So distress are mostly very speculative bonds for bonds or issuers that already have a bit of problem already. So yeah, and moving on to how the structure of bonds work. So if you look at bonds, there are various types of bonds structure out there. And if you look towards the right side here, you can see that for bonds, you can see it starts from the safest bond being the senior bonds. And as you move down towards the equity portion, you are getting higher risk. But I think in finance, the more risk you take on, you expect higher returns. So that is very similar to bonds. And I think one issue that's very pertinent with bond investors, especially retail investors, is when they start chasing yields for bonds, they may overlook certain features or seniority of the bonds. And that's where I want to talk about perpetual versus bullet bonds. So your bullet bonds are just your very simple bonds, senior bonds, without any options, without any special features. But then when you come to perpetuals, that's where it's very, very different. So I think if you look in the market previously, we have some perpetuals from Pestec, SciPark. So How are these very different? Perpetuals in the name basically means perpetual. So it means indefinite, in another word. So when you buy these perpetuals, you're actually loaning your money to the issuer perpetually. And why do I say it's perpetual? Because the features in the bonds allow the issuers to either call back at their option. So it's at the option of the issuer. So if they face any problems with cash flow or anything, you can see that they will just decide not to call back the bonds, and you will have to have your money with them for indefinitely until they decide to call. And I think one more thing that is risky about bonds is that while they can also not call back, not redeem the bond, and not give you your principal, they can also defer your coupons. So that adds another layer of risk there. So yeah, I hope this really clears the air. And I'm not saying that perpetuals are bad. You can look at good perpetuals from good names. Like HSBC has their perpetuals as well. And these perpetuals, while I'm not saying that they will redeem it, they are from quality issuers. So yeah, moving on to the third misconception. So I think just now I came in the morning and I talked to a few clients as well. And I think this question came up also. How do I know what's my return in my bonds? And I think this is the main question here, whether coupon is the return you'll get or the yield. And I think this is the main misconception among bonds, also for people who want to start investing in bonds. So I'll show you how you look at it. So if you look at coupons, they are the expected cash flow that you can get. So okay, if you look at your right here, this HSBC bond is showing a 6.211 in the name. That is the coupon you'll get. And that is the expected cash flow you'll get. But then with this 6.211, if you look at the price there, is $102. So you're buying it at a premium. So every time you buy bonds, you're buying it at $100 or the par value. So if you think about it in a simple mathematical way, right? So work with me here. Simple maths. 6.211, you're paying $2 for $2 extra, $102 for a bond worth $100. You already lost 2% there, right? So if this bond is 5 years, you annualize the 2%, just simple. So you'll probably be losing 0.4% a year. So 0.4%, you cut that off from the coupon you're getting, 6.2%. Your return annualized will be around 5.8. But this is just a general simple calculation to make things simpler for you guys. But I think in finance, there's a lot of discounting and everything. So you end up with 5.44. So yeah, in general, if you look at bond prices in the market, if yields go up, your bond prices will go down. And if yields go down, your bond prices go up. And I think, yeah, this will be my last point here. And if you notice the question mark over there, it basically is trying to tell you bonds could be confusing. But what I'm trying to say here is, yes, it could be confusing, but it shouldn't be so confusing for you guys. Because if you just stick to the basics, bonds are not at all confusing. If you just think of bonds as a fixed income source, something that will generate a consistent stream of revenue for you, then it's not confusing. And by sticking to the basics, what do I mean? Stick to investment grade bonds, quality names that you know. So in the Malaysian market, what are quality names that you can think of? Like YTL Power, Maybank. So these bonds, yes, they are quality names, but I'm not saying that they won't default, but they are quality investment grade names with very strong credit rating. Or you can just look at government bonds. So in the sense of government bonds, if you look at government bonds, if you're confident with the economy, so if you're confident with the Malaysian economy, the bond market, you will invest in the bond there. These are bonds issued by the government. So I think what I'm trying to say is when bonds start being confusing is when you start adding special features and options and better options in the bond. So that makes things very, very confusing and adds a layer of confusion there. And at the end of the day, for retail investors, I cannot stress this enough, stick to the basics. But if you still do find things confusing, we always have our CIS team. And also we will post weekly articles to generate ideas for you guys. as well. So do check out our bond page, and maybe you can get some ideas there, and you can read our analysis of bonds there. So yeah, that would be the end for me. Thank you very much. So for those who are invested in bonds, stay invested, get your consistent income stream. And for those who have yet to invest in bonds, we hope to welcome you into getting your own fixed income stream. Thank you.